Today, we're going to try and cut through some really complex legal changes coming out of Brazil. For any global business, Brazil has always been this land of, huge opportunity, but also just immense bureaucratic friction, especially when it comes to intellectual property and moving money around.
Oh, absolutely. That friction point, particularly around royalties and technical payments, has been a major roadblock for decades. But our sources are confirming a really fundamental shift is underway. Brazil has brought in these landmark new laws to modernize its whole foreign exchange and tax system. This isn't just a small tweak.
Right, this is structural.
Exactly. It's a total reform. And a lot of it is being driven by Brazil's goal of joining the OECD, the Organization for Economic Cooperation and Development.
Okay, so let's unpack that. We're not just looking at one law here, but two big pillars that kind of work together. First, there's the new transfer pricing framework. That's law, hashtag 14,596.
Yeah.
And second, the modernized foreign exchange law, which is law, hashtag 14,286. And the common thread here seems to be getting rid of these old, rigid limits. Some of them are, over half a century old?
They are. It's a move from an environment where you just, check a box or hit some arbitrary percentage to one where you have to prove actual economic substance. So for any multinational in Brazil, understanding this is, well, it's essential. It rewrites the entire rule book.
So let's dive straight into that first pillar then.
Yeah.
The transfer pricing, or TP, revolution. This became mandatory January 1st, 2024. You mentioned the goal is aligning with the OECD, but what was the practical problem on the ground that Brazil was really trying to fix?
Well, the problem was twofold, really. Complexity and inconsistency. Brazil's old TP system was incredibly technical. It was all based on these fixed margins and formulas that often had very little to do with what was actually happening in the market.
And that created problems like double taxation.
Exactly. You'd get these scenarios of double taxation where both Brazil and, say, the U.S. would tax the same income, or sometimes even double non-taxation. So by adopting the OECD model, and specifically the arm's length principle, Brazil is trying to standardize its rules, make things more predictable.
Okay, hang on. The arm's length principle, or ALP. For anyone listening who isn't deep in international tax, let's just quickly break that down. What does it mean?
In short, it just means that related companies, like a Brazilian subsidiary and its parent company in Germany, have to act as if they're complete strangers.
As if there were two independent companies.
Right. They have to transact at market rates. So if that subsidiary pays a royalty to its parent, the amount has to be what some unrelated third-party company would reasonably pay for the same thing.
And this new law actually gives them more freedom, as long as they can justify it.
It does. It gives them more contractual freedom, but, and this is the key, that freedom has to be backed up by a very rigorous economic analysis.
Which is where the old rigid system really starts to fall apart. Now we're talking about analyzing functions, assets, risks. The sources say the main method for this will be the comparable uncontrolled price, or CUP method.
That's right. CUP is the most direct way to do it. You basically have to find a similar deal between two unrelated companies to set your own internal price. But here's the reality check. For really unique IP, like, custom software or a specialized manufacturing process, finding a perfect outside comparison.
Almost impossible.
It's nearly impossible, and that's why the really fascinating part of this new law is how it deals with intangibles.
Ah, okay, so this is the aha moment. The shift from legal ownership to economic ownership.
Yeah.
Give us a scenario. Why does that distinction matter so much?
It matters for everything. Because look, legal title to IP is easy to move around. You can register a patent in a low-tax country just by signing some paperwork. That's legal ownership.
Right, and traditionally, that company, let's call it Patent Co., could then charge huge royalties to the operating company in Brazil.
Exactly. But under this new law, the Brazilian tax authority is going to look at who is actually performing the DEMP functions.
DEMP-E, that's the key acronym here.
Yes. Development, enhancement, maintenance, protection, and exploitation of that IP. So if the research lab in Brazil is doing all the development and enhancement running clinical trials, adapting the product, they are the economic owner, even if Patent Co. in some other country holds the paper title.
Wow, that is powerful. It basically stops companies from just parking their valuable IP in a tax haven where no real work is being done.
Precisely. If you want to justify a big royalty payment out of Brazil, you have to prove the company receiving it is the one doing the high-value DEMP work.
And what if they're not? What if they're just, say, financing it?
The law is very specific on that. If a company is just financing the asset or holding the legal title without doing the DEMPI work, their payment is capped. They can only get a return based on like a risk-free or risk-adjusted interest rate. They can't claim the massive profits that come from actual development and exploitation.
Okay, that is a huge conceptual change. You're trading paperwork for functional reality. So let's talk about the practical impact on deductibility. This is where those old restrictive limits finally go away.
This is the biggest practical change, yes. The elimination of the deductibility limits from Ordinance 43658.
1958.
1950, I mean, it was written when global business looked completely different. For decades, it put these strict caps, usually 1 to 5% of gross revenue, on how much you could deduct in royalty payments.
So just to be clear, if the global standard, the arm's length principle, said a 10% royalty was fair for some technology, a Brazilian company could only deduct maybe 5% of that payment.
That's correct.
Which would lead to double taxation.
That's it, exactly. That cap made Brazil really unattractive for foreign companies because they couldn't deduct the true economic cost of using their parent company's IP. The new law gets rid of those caps entirely.
So if you can prove 10% is the fair market price with your DEMPI analysis, you can deduct 10%.
Yeah.
And the law also gets rid of the need to register contracts with the BRPTO, the Brazilian Patent and Trademark Office, just for tax purposes. That seems like a big deal.
It's a massive reduction in red tape, but, and we need to put a pin in this, there's some necessary friction here. While the law is mandatory now, the Brazilian Tax Authority, the RFB, is still writing the full rulebook.
Uh-oh.
Yeah. The final comprehensive set of instructions on how to actually implement all of this in practice, we don't expect that until the third quarter of 2025.
Wait a second. So multinationals have to operate under this completely new, very complex framework right now.
Yeah.
But the detailed implementation guide is still being written. That sounds like a compliance nightmare.
It creates a lot of uncertainty. Companies are, relying heavily on their own interpretations of the OECD guidelines, hoping that what they're doing now will line up with what the RFB eventually says next year.
So they have to be proactive.
Yeah.
They need to be building their DEMPI documentation now, basically guessing what the final rules will look like.
Absolutely. The risk has shifted. It's no longer about arbitrary limits. It's about the subjective nature of your economic analysis and whether an auditor will agree with it.
Okay, that clears up the tax deduction side law 14,596.
Mm-hmm.
But what about actually getting the money out of the country? That's where the second pillar, the foreign exchange reform, comes in. Law hashtag 14,286. How does that simplify things?
The FX side was just as difficult, really. It was all overseen by the central bank. Previously, to send royalties abroad, that BRPTO registration was vital. You needed it to make the contract valid, to get the currency out, and to get the tax deduction.
3 separate hurdles.
Yes. The new FX law attacks that middle hurdle, the remittance itself.
So what's the new requirement for sending royalty payments now?
It's almost shockingly simple. It now only depends on proof of payment of income tax.
That's it.
That's it. All those old formalities are gone. For remittance, you don't need BRPTO registration anymore. You don't need central bank approval. You don't have to prove your patent is still valid just to send the money.
And this FX law also went after that same 1958 ordinance, right?
It did. Law 14,286 explicitly revokes the quantitative limits on the amount of royalties you can send abroad. Before, the central bank could just step in and cap it, often at that 5% ceiling. That power is gone.
So if you put it all together, it's a unified framework for liberalization. The 1958 ordinance created 2 massive problems, a tax deductibility problem and a physical remittance problem.
Exactly. And the FX law solved the remittance problem. You can send the full amount. And the TP law solved the deductibility problem. You can deduct the full amount. It's a beautifully synchronized piece of deregulation.
So let's connect the dots. For the multinational company listening to this, how does this change their strategy for Brazil?
The fundamental takeaway is that legal box ticking has been replaced by economic reality. You can remit and deduct far higher payments than before, but only if you can defend that value with sophisticated analysis. The focus has moved away from paperwork and toward demonstrated substance.
And this all feels like a critical step for Brazil's bid to join the OECD. It shows they're willing to adopt these complex global standards.
It absolutely is. It's a huge maturing of their legislation. Moving from simple percentages to a globally accepted analysis like ALP and DEMPI, it signals Brazil is serious about attracting long-term investment.
Okay, but let's be critical for a moment. The old system had risks. Companies could manipulate revenue or just eat the cost of double taxation. Doesn't this new system, which is so reliant on subjective analysis like DEMP, just trade one manipulation risk for another? Won't companies now just try to game the system on paper?
That's the exact risk, and it's why that RFB guidance in 2025 is going to be so important. The new system is more sophisticated, yes, but it definitely opens the door for aggressive tax structuring. The difference is that the new limits are subjective. They're determined by an auditor's interpretation of your functions, assets, and risks.
So the scrutiny will be much higher.
It'll be intense. Companies have to prove that the people, the assets, the capital required to perform those DEMPI functions are genuinely located where they say they are. You can justify a higher deduction if you shift more development into Brazil, but you better be able to prove that reality with headcount, investment, and facts on the ground.
So the mandatory homework for MNEs is an immediate review of their global IP structure.
It is. You have to. You can't rely on those old fixed caps anymore as either a constraint or a safe harbor. You have to reevaluate everything under these new ALP rules.
It's a massive transformation. Brazil has gone from a system defined by a 1958 ordinance and strict registration to a modern framework centered on economic reality, on DEMPI and the arm's length principle.
The ultimate summary is that the regulatory risk is now entirely focused on substance. If you can't demonstrate the reality behind the payment, you're at risk. If you can, the old ceilings are gone.
Which leaves us with a final provocative thought for you, the listener. Given that this new system hinges entirely on demonstrating functional reality through DEMP, how might this change the fundamental nature of IP agreements? Does this framework actually encourage companies to make genuine investments, to shift real development, risk, and key people into Brazil to justify higher deductions? Or will the compliance uncertainty, which will last until late 2025, just encourage them to wait and see? Something to consider as you review your global IP strategy.